Wednesday, May 20th, 10 a.m. Eastern. In exactly 6 hours and 20 minutes, the closing bell will ring, and at precisely 4:20 p.m., Nvidia will release its first quarter earnings report. Wall Street is braced for a shock. But it is not the revenue numbers that have institutional traders panicked. It is the options market. Right now, options pricing indicates an expected price movement of 6.5% in either direction immediately following the release. In terms of market capitalization, that 6.5% swing translates to a potential $355 billion shift in value, $355 billion created or erased in a single session. To put that in perspective, that single-day swing is larger than the entire market value of 90% of the companies in the S&P 500. This is not about chip sales. This is about a massive options squeeze trap, a setup where market makers who sold billions of dollars in calls and puts are forced to buy and sell millions of shares to balance their books, creating a feedback loop that could destabilize the entire index. Let me show you the sequence. Here is the sequence. 9:30 a.m. the opening bell rings. Nvidia options volume immediately spikes, accounting for more than 30% of all options activity in the entire U.S. stock market. Traders are buying short-term call options, betting on a rise past $1,000 a share. 10 a.m. Target Corporation releases its first quarter earnings report. Sales are flat, but credit card delinquencies are rising. It is a warning sign that the underlying consumer economy is weakening, placing even more pressure on Nvidia to keep the market afloat. 1:20 p.m., 3 hours remaining in the trading session. Large institutions begin buying protective put options at a record rate. The purchase of these options acts as insurance, indicating that even the biggest players are hedging against a major market crash. 2 p.m. The Federal Reserve releases the minutes from its April policy meeting. The minutes reveal that Fed officials discussed liquidity risks in the financial system and the pace of balance sheet reduction. The bond market reacts immediately, with the 30-year Treasury yield climbing closer to 5%. 4 p.m. The closing bell rings. Market makers calculate their final positions. Order imbalances pile up in the final seconds of trading. 4:20 p.m., the hard deadline. Nvidia's press release drops, the numbers are published, and the options squeeze begins. Translation: as the broader economy slows and the Fed tightens liquidity, the entire weight of the stock market has been concentrated on a single corporate earnings release. Subscribe. This countdown is moving fast, and the next few hours will determine where the market lands tomorrow. Let me show you what is in the documents, because when you look at the options data, you see exactly how the trap has been set. First, look at the Options Clearing Corporation volume sheet. Page 14 shows a heavy concentration of call options with a strike price of $1,000. In options trading, if a stock rises toward the strike price of a call option, the market maker who sold that option must buy shares of the underlying stock to hedge their position. This is called delta hedging. Translation: if Nvidia's stock starts to rise after 4:20 p.m., market makers will be forced to buy millions of shares to cover their short positions, pushing the stock price even higher in an artificial squeeze. That is not speculation. That is the mechanics of delta hedging. Now look at the earnings expectations document. Page 4 of the Q1 consensus report shows that analysts are expecting revenue of $78.8 billion and earnings per share of 1.77. But look at the guidance column. To justify its current valuation, Nvidia must guide for second quarter revenue of $84.2 billion. Any guide below $82 billion will be viewed as a growth slowdown, regardless of how strong the Q1 numbers are. Stay with me. The risk is not in the past quarter. The risk is in the future supply. Page 8 of the supply chain audit reveals that Nvidia's main manufacturer, Taiwan Semiconductor Manufacturing Company, is operating at 100% capacity. There are no additional production lines available for Nvidia's new Blackwell chips until the fourth quarter. If the supply is capped, the growth is capped, and if the growth is capped, the valuation model falls apart. Finally, look at the Federal Reserve minutes released at 2 p.m. Page 3 contains a warning. The text states, quote, "Members noted that the concentration of market capitalization in a small number of technology entities increases the vulnerability of the broader financial system to idiosyncratic operational or financial shocks." End quote. The Fed itself is warning that a single company's earnings report has become a systemic risk. Here is the trap. Market makers are caught in a double-sided squeeze. If Nvidia beats expectations and guides higher, the call option squeeze triggers, forcing them to buy shares. If Nvidia misses, the put option squeeze triggers, forcing them to sell short to hedge their downside risk. In either direction, the market maker's hedging activity will accelerate the move, turning a standard earnings report into a high volatility event. No option leaves the stock market stable. Dan Ives, managing director at Wedbush Securities, has argued that, quote, "Nvidia's earnings are the structural foundation of the entire technology sector. A strong report will validate the massive capital expenditure we are seeing from Microsoft, Google, and Meta. A weak report or soft guidance will raise serious questions about the return on investment for artificial intelligence infrastructure." End quote. Stacy Rasgon, senior analyst at Bernstein, noted that, quote, "The key metric is the gross margin. If Nvidia's gross margin drops below 75%, it indicates that the cost of producing Blackwell chips is rising faster than the company's pricing power. That would represent a fundamental shift in the company's profitability model." End quote. Now, here is the fair counterargument. The options market is pricing in a 6.5% move because implied volatility is at an all-time high. But often, when the news is released, the actual stock movement is much smaller than expected. When this happens, the value of both call and put options collapses. This is called an implied volatility crush, or IV crush. If the stock moves only 1 or 2%, the options premiums will evaporate, and the market makers will collect the profit from the expired options. The tech sector will remain flat, and the S&P 500 will continue its slow trend. That is a highly likely outcome, but it requires Nvidia's results to match the consensus estimates perfectly, with no surprises in the guidance or the supply chain data. In a market where tech stocks are priced for perfection, a perfect match is rare. See the pattern forming. Let us bring this down from the trading desks to the real economy. For the average investor, this options trap is not a distant game played by hedge funds. Nvidia now makes up over 6% of the S&P 500 index and more than 8% of the Nasdaq. If you own a standard retirement account, a target date fund, or a broad market index fund, your wealth is directly tied to this stock. A 6.5% drop in Nvidia will drag the entire index down with it, reducing the value of your retirement account in a matter of minutes. Furthermore, we must look at the consumer data. While tech stocks trade at historic highs, retail earnings from Target show that the average consumer is struggling. Delinquency rates on credit cards have reached a 13-year high, and savings rates have dropped to 3.4%. But consumers are putting basic groceries on credit cards to cope with inflation. Translation: The stock market is setting records based on the expected growth of AI infrastructure, while the physical economy is showing signs of consumer exhaustion. Like if you're seeing how a $355 billion swing in a technology stock can impact your retirement portfolio, even if you have never purchased a single share of an 3 scenarios for how the option showdown resolves after 4:20 p.m. Scenario A, the breakout squeeze. Nvidia beats Q1 expectations, reporting $80 billion in revenue and guides for $85 billion in Q2. The call option squeeze triggers. Market makers are forced to buy, and the stock surges 8%, adding over $400 billion in market cap and lifting the S&P 500 to new highs. Probability, 55%, supported by the strong demand from hyperscalers. Scenario B, the margin drop. Nvidia beats on revenue but reports a gross margin of 74% due to Blackwell production costs. Guidance is flat. The put option squeeze triggers. Market makers sell to hedge, and the stock drops 7%, erasing $380 billion in value and dragging the tech sector down. Probability, 30%, driven by supply chain bottlenecks. Scenario C, the volatility crush. Nvidia matches estimates, and the guidance is exactly $84 billion. The stock moves less than 1%. The options premiums collapse, wiping out retail options buyers on both sides, while the broader index remains flat. Probability, 15%, least likely because of the high expectations and market focus. Which scenario do you think is most likely? Share your thoughts in the comments. Active clocks, 4:20 p.m. Eastern, 6 hours from now. The earnings release drops, the numbers will be published, and the initial reaction will flash across the screens. 5 p.m. Eastern, the conference call begins. CEO Jensen Huang will address the Blackwell supply constraints and the demand outlook. This call often reverses the initial market reaction. Tomorrow morning, 9:30 a.m., the market opens. The true systemic impact of the option squeeze will be realized as institutional portfolios rebalance. 3 things I am tracking. 1. The gross margin percentage. That is the true indicator of profitability. 2. The guidance figure. Anything below $84 billion will trigger a sell-off. 3. The 30-year Treasury yield. If the bond yield passes 5%, it will pressure stock valuations regardless of Nvidia's performance. I will monitor the release at 4:20 p.m. and break down the conference call as soon as the transcript is available. Subscribe. The battle over the $355 billion option trap determines whether the tech sector can sustain the stock market or if the economic reality will force a correction. That is not speculation. That is the options chain data. I read the documents, so you don't have to